Good morning. What is DSCR lending? All explained in 3 to 5 minutes. So, if you invest in 1 to 4 unit rental properties, chances are you've heard the term DSCR loan. But most investors don't fully understand how it works or why it's become one of the most powerful financing tools in today's market. So, here's the short version. DSCR lending qualifies the loan based on the property's income, not your personal income. And that's exactly why DSCR loans are popular with real estate investors, self employed borrowers, and short term rental owners. So let's break it down pretty quickly for you. What does DSCR mean? Well, DSCR stands for Debt Service Coverage Ratio. And what it does is it measures how well a property's income covers its mortgage payment. So let me throw a formula your way. The DSCR is equal to the monthly rental income divided by the monthly housing expense, all in. And most lenders look for a DSCR between 1 and 1.25, depending on the loan program and property type. So what property types will qualify? Well, DSCR loans are designed for non-owner occupied 1 to 4 unit properties. So that can include long-term rentals with 12-month leases or short-term rentals like Airbnb and VRBO, but also single-family rentals, condos and townhomes, and small multifamily properties. So 2 to 4 units, 2, 3, 4. But you do not need to live in the property, nor should you if on an investment property loan. But what income is used for these to qualify? Well, this is where DSCR loans differ from traditional mortgages. And the income is based on long-term rentals. And for those, we would qualify using current lease rents or market rents from an appraisal. Or we would have short-term rentals, which would qualify with 12-month of air DNA projections or documented short-term rental income and expense statements. So there's an important caveat here. In short-term rental DSCR loans are typically going to require a higher debt service coverage ratio and larger cash reserves, but they'll also face a little stricter underwriting too. And really, that's the trade-off for using a vacation rental income as compared to a traditional long-term lease. So let's look at credit, income, and documentation. DSCR loans are designed to be simple. So no tax returns, no W-2 statements, no personal income calculations, and no pay stubs. But credit scores typically are 620 to 680 is usually a good bucket. But right now, the secondary market's looking for 660 or higher. And LLC ownership is allowed in virtually most cases. Now, the property's cash flow does the heavy lifting is the concept. So let's look at down payment and reserves. So what are your typical requirements? Well, 20 to 25 down payment, a percent down payment based on how many units are involved. But you may need 3 to 12 months of reserves, and there could be higher reserves for short-term rental properties. And rates are generally higher than owner-occupied loans by about a point, but the flexibility is the real value of the DSCR loan. So who should use DSCR lending? Well, DSCR loans are ideal for real estate investors that are going to scale their portfolios, or for self-employed borrowers with complicated tax returns, or for short-term rental owners, but also clients writing off income aggressively on their tax returns. And also investors who like to refinance without income headaches to complete a BRRRR strategy. So the final takeaway for the DSCR lending topic is it's one of the fastest ways to acquire or refinance rental property without income verification. And as long as the deal makes sense on paper, we can move it forward. If the property cash flow works, the loan works. And structuring it correctly can save you time, money, and frustration. And that's what I'm here for. My name is Bill Rapp. Please visit my website, billrapponline.com. You can get more information on products and figure out how to get a hold of me. Love to talk to you more about your project.